Doug, good morning.
Good morning. Good morning, Zoom friends.
The computer's not cooperating, it seems like, so this is kind of interesting, but welcome. It's good to see you. I'm getting ready to show you the disclaimer here. Another Friday, another time to hang out with you guys.
Hey, and it is fall weather. I hope it's beautiful where you are. I know it's leaf season for us. I mean, that's what's coming around the bend. Is I've done leaves one time, and if you're in the leaf business, I would think you'd just be so excited right now.
Yeah, I want to give a shout out to Justin Groff and Just in Time Landscaping. Uh, they are just a cool group of people. They do Gimbal's leaves because I don't know who else does them. Do you?
We also have green grass, thanks to
Yes.
Just in Time.
Thank you, Justin. Cool group of people. Hey, just in case you didn't see the disclaimer today, don't pet the coyotes. You can't make that stuff up. I was traveling in Arizona 3 or 4 years ago, and I was at the Grand Canyon, and this was a sign I saw.
I was about ready to ask, like, where did you come from?
Yeah, you can't make it up. The national parks, I think, are arguably the best way to watch people take foolish risks. Like I don't know that I've ever been to a national park where you haven't just seen like a Darwin Award winner going on there.
My favorite part about that sign is somebody got paid to make that sign. I don't know if it was internal or if it was that they hired some firm and they approved, like they had like 12 bids for the job. And they're like, yeah, that's the one.
I think they hired Cheech and Chong. I think they're going, you think people really are petting the coyotes? Yeah, I don't know. That's at the Grand Canyon. Go see the national parks that you pay for them. Go enjoy them.
If you do go to the national parks, you might want to take with you some bear spray.
Doug, how'd you know I was coming out with the national parks today?
I brought this out just for the bear market. I don't know why this is in my desk. Did I give this to you?
I might have given it to you. I don't know. It's probably the floating. Do you know how to identify bear scat?
No.
It has bells in it, and it smells like bear spray.
Okay, that makes sense.
Sorry about that, folks. That was just a bonus this week. Well, how about the bear market? Let me pull a chart up for you here, Doug.
So there are, yeah, did a little recording today on Market Smith. This is the tool we use every week. And we look at stock prices, we look at action on volume, and this tool, Market Smith, it's really an awesome wonder because back in the day, man, we paid a lot of money for stuff like this. You remember?
Oh, I had a little shelf between the office I was in and the other, and it had a rotating little shelf with a Quotrek machine on it.
Okay.
And I think the Quotrek machine cost $1,000 a month.
Well, I'm pretty sure that when we were using a souped up version of what you all see right now, the price we were paying was equivalent to my salary at Gimbal Financial.
Oh yeah. It was,
and so this is awesome. This service, this Market Smith service we use, it's very affordable, and it's just got some great screeners on it. And one of the things that I like to pay attention to is earnings expectations. Ever since reading the book Dancing with the Analyst, I've just been fascinated by earnings and expectations and how we even get there. But check this out. There are 1,400 stocks in the next 14 days who will report earnings.
Have you worked for a publicly traded company?
No, I never have. E.G. Edwards was not publicly traded. No.
Yeah, so they lose their minds when the earnings come. So like it shuts down maybe the whole corporation. Everybody's cranking out numbers and putting now their PowerPoints together. It was one of the most absurd things in the business world for me to watch what happens.
So like at Texas Instruments, you noticed that or you sensed that?
Oh, it was our portion, like we were a small portion of the whole picture. it would be 2 weeks of putting presentations together to get to the manager, who would take it to the manager, who would then take it to the manager for the quarterly report.
Okay.
So that was in the 80s. I can't even imagine how psychotic they are today.
Yeah, I can't imagine it either.
Yeah, so just think, what'd you say, 1,400?
1,400 in the next 14 days.
Yeah, just
a lot of broken dreams.
The process of doing those is so much wasted time. I can't even imagine. It's like doing what do you call them? Annual reviews for employees. Like
yeah, 4 times a year.
Oh,
brutal.
Yeah.
In this past week, since we've met everybody, this past week's been really wild because the tech stocks had been leading out. And we saw a few of the tech stocks, the leaders, the type of stuff that you all use every day, multiple times a day. Those tech stocks have really fumbled the ball. And they had decent earnings, really.
Yeah.
It just didn't meet the expectation. And then the reaction to the price sold off. And so what we've been seeing is the reaction to earnings announcements here in the last week have just been tough. And so that's why we have down arrows.
I heard on some research I was doing that this is a Roberta Flack market.
I know. How should I know?
Killing me softly is what they said. It's slowly just grinding away out there. I didn't make it up. I heard it.
That's what it feels like. I mean, you look back to July when we were hitting highs in the market, and then August was kind of the warning shot across the bow. Had a couple opportunities in September, and then sell off until now. But going into fourth quarter is a time when companies are spending money. They've got extra money to get rid of and deals to get done. They're being motivated to get stuff done. And so I'm always pretty optimistic, but I'm optimistic about fourth quarter just to see what happens, because this, at some point in time, the sell-off, there has to have some buyers come in.
For some reason, this market came to my mind here, and I don't know if you remember this, but this was 2011 market. Yeah,
very difficult.
Yeah, look at this right here. We went from 28, well, you could say 2880 to 2300 in maybe 20 trading days. That's just a punch in the face.
Well, and today, Keith gave me this stock almanac. I know if you've tuned in since January, you've heard me talk about this, but the stock almanac today, 94th anniversary of the 1929 crash.
Today,
down 29% in 2 days, October 28th and 29th.
Well, last week was the 36th anniversary of the 1987
yeah,
crash.
We talked about that.
Yeah, so October has been a gruesome month, not to throw out any Halloween puns, but it's been historically that way.
The markets, so Keith went back in time to 20.
I brought it back to 2023.
Okay. I mentioned last week that one of our friends was talking about the 1966 to 1982 market.
Oh, yeah.
And you had inflation, you had rising rates, you had war, you had lack of leadership in Washington. But during that time, you had markets where they would come up and hit 1,000. Oh, you're getting there.
I'm trying to get there. I got to go to the Dow. It's the only place I can get it.
Yeah. So the market would come up right to 1,000. Nice, Keith. And then it would retreat. And it did that 5 times until you roll back into Ronald Reagan. And he in Congress, Senate, they all got their heads together and they started to cut taxes. And that was the spark, that was the catalyst that led to a 17-year advance from 1,000 to nearly 12,000 in year 2000. And so a huge run up. And so we always have to be prepared. And that's one of the best parts of our country is the innovation piece. What can get us out of this mess we're in? Innovation. And some of those innovators during that time, check these out. Walmart, WD-40. WD-40. Wild, huh? And then here's one, LEV.
I don't know that one. LEV.
You may have bought a sofa there.
Help me out.
Levitz.
Levitz.
And Levitz was a just a killer stock, a powerhouse. And basically what they did is they took home furnishings to the next level by warehousing them, allowing you to save some money by carrying your own sofa out of their warehouse. But they just did things differently. They furniture, whatever, but they operated differently. They cut costs. They appealed to the buyer. And that's the type of stuff that will move markets. It can pay debt. Innovation is it. Innovation will lead us out. So constantly looking for that next thing. And a lot of times it's retailers.
I'm not sure why this chart doesn't go back farther, but you said 1960 something.
Yeah, 1966, I believe.
Yeah.
I found an article written by William O'Neill, and then David Ryan highlighted it. It's very, very cool.
Yeah, because it was really over here in this time frame right here where everybody said just buy and hold on, is where that became a prevalent thought in the 1980s over here. I would think anybody that lived through this market where it bounced up and hit 1,000 and dropped back down would absolutely say that's the most absurd thing I've ever heard. And so to hear us not buying and holding might sound like we're sacrilegious or some kind of cult or something, but that's been a constant in market history over time.
Yeah, and just the idea is to protect capital, and it's during those markets where you have sell-offs like that 72 to 74, where the erosion of capital. I mean, look at that. That's pretty intense. So if you were needing your money or counting on your money during that time, it's very difficult. And if you had to borrow money during that time, I didn't even look and see what rates were, but I'm sure they were ridiculous.
I had the opportunity to work with brokers that got into the business in this time frame here when I started. And
I bet they smoked
they smoked, and I was with them on this day here in 1987. And I don't remember seeing anybody more scared in my life than those men. I was too naive to be scared, but to see the looks on their faces of what was happening, it was pretty intimidating. But they had to call clients during this time and just, I don't know what they said. Like your capital dropped in half. It came back, but this was a bad economy. Like that was a tough time in history. It was a tough time, like psychologically. I think I mentioned in the past that beef prices were up and they were eating horses back then. Yeah. All kinds of crazy stuff was going on that was the end of Vietnam. That was when President Nixon, just a lot of crazy stuff is going on. And that's usually what's happening at bottoms in the stock market is there's some bad stuff going on. Maybe you could say maybe there's conflict in Israel, or you could say maybe there's high gas prices and high inflation, things like that. More often than not are the bottom of a market than the top of a market. So that's maybe good news of where we're at right now.
I was listening to an IU economist the other day. No, he's an Indianapolis University economist. And he was telling the audience how you just want to buy and hold. And then he said, but because of where we are, we're taking a look at treasuries right now. I was like, okay. So even the buy and hold people don't believe in buy and hold.
Well, you have to have a strong stomach when you go through those bear markets and see what happens with them. So very interesting.
Yeah.
Do you need to look at any other charts here, Doug? What do you want to see?
I don't think we need to. I mean, if you want to fly through them real quick, they all kind of look the same. Basically, what we're in a correction period where we have more sellers than buyers. And that's been the catalyst of rising rates, inflation, missed earnings expectations or guidance, and it's going to be choppy. And so there's really nothing new to tell. That every chart looks similar. Yeah, that one's really bad. But there's a lot of similarity between the charts, mainly because of the influence of the top stocks within these indices. And we've talked about that on the NASDAQ. Similar tech stocks are wrapped up in the S&P. And so it's those FANG type stocks that have had a tremendous influence.
And it's hard to know like when the end of the run will be for those things. I would have thought that it would have been 5 or 6 years ago, and they've rallied anything I could have expected.
Yeah.
Yeah.
Well, Levitt's, they're not trading today. So, every company has a life cycle. And how do you know? Well, you just know by price and volume.
Yeah, boy, I think of my childhood. Sears and Roebuck was the Mac Daddy retailer, right? Like you could buy guns there, you could buy clothes there, you could buy everything. Yeah. And if you would have said back then that Sears and Roebuck would be out of business, I don't think anybody would have believed it. Do you?
Probably not. I mean, and there's companies we could rattle off today that if you looked at their balance sheet, we could pull them up on Yahoo Finance, and you would see red next to their tangible assets. And
right.
So it's pretty, that the balance sheet tells the story. And the Sears balance sheet, that was pretty ugly for a long time.
Balance sheet is what you own less what you owe. And unfortunately, or fortunately, I don't know, people don't necessarily pay attention to that, your net worth. And it doesn't lie. It can't lie. If you don't have any wealth, eventually you just run out of answers for the marketplace. And a lot of big companies got to that place first before the market realized how bad their finances was. The one that comes to mind during 07, 08 was General Motors. Most of you maybe forgot they went bankrupt, went out of business. And the General Motors today is not the same one that was there in 2008. And so, but if you had looked at their balance sheet back in 2006, you could tell they're running out of money.
So, Keith, you highlighted, speaking of balance sheets, Ralph and Irvina. And what do you think their balance sheet would have looked like? What was that, like early 1900s?
Yeah, so Ralph was my grandfather, Ralph Waldo. How's that?
You highlighted them in the newsletter. If you need a copy of that, we'll send it to you.
Yeah, Ralph Waldo. And then he married a young lady, Irvina Almira. How are those for some names? That's the 1900s names there.
And maybe you'll have some grandkids with those names. Become cool again.
The Ralph name got passed down. Yeah, I mean, they would have come to age in the 1920s. So that was the boom, right? Like that. And that was all. Cool I mean, stuff. It would have been a cool time.
Very cool.
But it shot up, and then when we hit that crash that you said, was it today? Was the anniversary or
28th? That day.
Okay. Yeah. And so all of that happened that quickly. Then when you look at the history of that, the people that were lining up at the soup kitchens, they were sporty dressed people. They had top hats. They had waiting for food. And imagine their self-esteem and how just difficult that would have been for them. And that went on really for 2 decades, because you had the Great Depression and you had World War II in the 40s. So yeah, I don't know. My grandparents would have been in their 20s during the boom of the 20s.
Yeah.
Really, you don't have any wealth when you're in your 20s, do you?
The way I read those newsletters was like, okay, if I'm a financial consultant meeting with your relatives, what are we talking about?
Right. Because the history repeats itself, right?
Our questionnaire.
Yeah.
The Gimbal questionnaire, I think, is pretty cool. It does have some quantitative stuff like, hey, what do you own? What do you owe? Like Keith was talking about, you subtract one from the other and you have the net worth. But then it has some other stuff that your family could have answered.
Right. Quality of life things, right?
Yeah. Like, okay, it's your 80th birthday today. What are you going to look back on with the greatest joy?
Right.
Okay. Your family could have answered that question.
Yes.
And so that's the type of stuff that those non-financials that always end up driving. Yeah, the financials are moving the needle.
And this series in the Anchor is just designed to point out ideas that are basic ideas that sometimes I don't talk about in the Anchor. Basic ideas that I just realize that probably people aren't being taught anymore. And just to emphasize those, this month that'll come out here in a couple of days, talking about the idea of compounding, which to me is an elementary thing, but to others it's kind of difficult. Excuse me.
Yeah. So on the compounding front, like there's several ways to see that. If I let the leaves just keep coming down and keep stacking up exponentially over the next 14, 21 days, I'm going to have a humongous mess on my hands. That if I just can do a little bit at a time, then I'll be able to still go out to dinner or go to my kids' sporting events and stuff like that.
And you can see it in not only financial ways, but things like that. Excuse me, Doug, you may have to leave.
Hey, it's all good. So when I think about what you're writing about in the newsletter, one of the things that stuck or jogged my thinking process was just the idea of having good communication with the ones who are closest to you. And so if it's your spouse and you're talking about where are you on the spender saver curve, keep through this diagram that shows a spender on one end, a saver on the other end, and then kind of an arc, and just kind of plotting out where are you, and then being able to communicate and talk about that with the people closest to you is really important. And so that could be you're getting ready to send your daughter off to college, and they're thinking, hey, we're looking at Princeton here, right, Dad? And you're thinking, I was thinking about WGU.
Exactly.
Just having that conversation of what does this really look like for your goals and where you want to be in life, but where you want to be in the future.
And those are some of the, excuse me, this cold's getting me, some of the notes I had, but the idea of banks are kind of financial trainers to people is really an interesting thought, because yes, banks do not make money by you putting money in a CD. Right. And so I dug out this book off of my bookshelf just to point out the kind of irony of the financial services. Where are all the customer yachts? A good hard look at Wall Street. This book was written in the 1940s, and the idea is, are the advisors you're working with on the same side of the table as you? And banks can be great resources, but they're not making money unless you borrow from them. Yeah. And so I don't think that even the average kid going to college even understands that idea, that they think the bank's working for their advantage. And the fact is the more debt you have, the harder it's going to be able to do the things that are important to you on that quality side of life.
Especially when those rates are climbing. I mean, that's basically what got some of the banks in trouble earlier this year, is rates climbed really fast and they couldn't keep up.
Right.
Their payments got too big.
Well, and this week, I think, was the first time we've got to the mortgage rates over 8% since I got my first mortgage. I'm not sure, but that idea is just a mental block for people, but it has an impact on the world, just the way you think. When you think about your own journey, like where you've come along the way and the hereditary kind of part of this thing, what kind of intentional training do you think your folks did that you can remember?
Well, I think one of the highlights for me when I look back and think about money and what are my first memories of money, it goes back to my dad having interest in the stock market. And it really began with Peter Lynch. And just remembering my dad reading Peter Lynch books and talking to me about a mutual fund and how it's so cool that you could own this one thing where you have people and making decisions for you, a team that is working for you on your behalf. And so that's what I think of when I think about stocks and investing specifically, is my dad and Peter Lynch.
That's really interesting, because my dad probably is like 20 years older than your dad. And in that 20-year span, education to people like your dad happened. Like my dad had no idea about any of that stuff, and he wasn't unusual for his age. And that's kind of the idea of how this historical thing impacts the ideas of finances. So intentionally helping you understand what a mutual fund was, that conversation never happened.
Well, and I think it was just more he was excited about it.
Right.
And we were living in the same space.
Yeah.
I don't remember a sit down, but just being around him, he was excited. That rubbed off on me. So
I got my MBA, a little pound my chest here moment, in 1984, and it was kind of a big deal in case you guys wanted to send me a congratulations. But I got that in 1984, and I got it in finance. And I did not, when I walked away with that degree, I had no idea what a mutual fund was in 1984.
That's interesting.
Right.
Yeah.
Yeah. So I would think probably most college kids know what a mutual fund is today.
But your dad gave you a great lesson, because I remember I rolled up in my dad's 84 Z28. And
Yeah.
you when I did that, Keith had a flashback
Yeah.
of like probably an MBA degree and thinking big, dreaming big, and next thing a freshly graduated MBA student needs is a Camaro. And so you were like, didn't you say that your dad advised you not to buy the Camaro?
Yeah, Steve Garrettson and I both were moving to Texas. Steve graduated from IU. He was going to work for IBM, and I was going to work for Texas Instruments. We had a little competition about that, but we were talking one night, probably over a beer or something, and we said, why don't we go buy 2 for 1? And it was that exact same car. And I came home amped up to own this thing, and my dad's like, you ought to reconsider that. That's not a really wise decision, Keith. Getting in debt that much at this point in your life is probably not wise. And I was my dad didn't know anything when I was 22, right? Like, and then I thought about it for a few days, and I yielded to his wisdom, and it was probably one of the best lessons he taught me.
Those principles have been around.
Right.
I mean, there's an old book, an ancient book with all kinds of information about debt and ownership. And so that's been around a long time. And so even though Peter Lynch came out and was making families, helping families grow their wealth, your dad's advice that's just timeless advice.
And what was really cool about it is Dad was not good at that stuff. Like, given the opportunity, he probably would have rang up the debt load, but he was teaching from what he had learned through the School of Hard Knocks, which was really cool. That's one of the notes I wrote down about how did your folks train you. What was intentional and then what was observational training, which that all kind of fits into the realm of training. Some things are just watching how things work and going, oh, that didn't work so well.
Yeah.
Maybe that did work well.
Yeah, in their environments. I mean, like, our kids are watching us in a different environment that they might be raising their kids in.
Yeah, and like observational in the house I grew up is that there wasn't a calmness about finances. There was a disagreement, a subtle one, which taught me, man, this could be a place of conflict or it can be a place of conversation. And then, as you'll see in this month's anchor, I put that arch in there, and I pointed out that where you two end up, you and your spouse end up on that dynamic, that line in between them can be the conversation or the conflict point. If one of you is a spender and one of you is a saver, if you don't talk, probably going to be a good amount of conflict. Yeah. And so conversation, communication, and trying to do the best you can in those situations is really a big deal.
Well, man, I'm looking forward to a chart that's moving in the right direction. Maybe we'll have that for you next week after I spray the stock market with some of this spray today. But just stay focused and know that innovation does play out. And it does win. I mean, America is the best place to be doing business today. It'd be the best place to start up a business today. And so I'm excited to see what's ahead.
One of my friends asked me about Italy this week, and he said, "Did you know the interesting thing about Italy is their economy is all driven on the past?"
Oh man!
And I was like, "Wow."
And stuff like tourism.
Yeah, tourism. Come to Rome and see all these ancient buildings. It's all built on the past. And that's not the case with the United States. It's all built on the future. That's why people are swimming to get here, doing everything else. Is the possibilities of the future. That's the United States. That's the cool thing.
It chokes Keith up.
Chokes me up just thinking about it. You guys have a great weekend. Go watch some high school football. Anything else that you do?
I don't know. Go for a drive.
Rake some leaves.
Bye.